everyone. Thanks again for joining us for another episode of the Fen Talks podcast. On today's episode, we have Steve Good, who is one of our business lawyers with an emphasis on tax planning, joining us for a conversation about the Biden tax changes. So Steve, thanks so much for being here. So for those individuals that haven't had the pleasure to meet you in person or review your bio, would you mind just telling everyone a little bit more about who you are and your background?
Sure. I'm, like you said, a business lawyer. I represent closely held businesses, high net worth individuals and families, family offices, but all kinds of business in transactional matters. And the emphasis that I bring to the table on doing deals is the tax planning associated with it. So if one of my partners has a M&A transaction that has some tax aspects to it, that's where I get involved and help them sort through that and try to come up with ways to make the transaction more efficient from a tax perspective. Also work closely with families that are typically successful entrepreneurs and trying to preserve their wealth and pass it down to the next generation, hopefully with kids and grandkids that get involved in the business, and how to do that on a tax efficient manner. I have had the privilege of being at Fennemore for it'll be 30 years this fall, working with over the years some terrific lawyers, and that's how I got into the tax planning world, was kind of hitching my wagon to the right folks here, going along for the ride.
Well, you must have started at Fennemore when you were 10 years old, because you certainly don't look like you've worked at the firm that long, but I know the firm certainly values our long tenure team members, and you've made a long-lasting impact within the team at Fennemore. So appreciate you sharing a little bit more about who some of your key clients are and the individuals that you help on a consistent basis. But what we're here to talk about today are those Biden tax changes. So would like to get your thoughts and your input and hear a little bit more about what are the most significant changes that will impact taxpayers if the plan is adopted. Do you mind expanding on that?
You bet. When Mr. Biden ran for president, it was clear that one of his policy objectives was would be to increase taxes. And that's consistent with, I think, the overall Democratic view of how government should be run and who should pay for what. And when he was elected, I think fairly quickly it became apparent that some of his programs that he and the Democratic Congress wanted to get through would be expensive. And so in April of this year, the administration through the Treasury Department introduced their fiscal budget for 2021-22. And as part of that, they unveiled all of the tax law changes that they for their wish list, I guess I'll call it. The most important thing, I guess, to take away is that for pretty much every taxpayer, the proposals will mean higher taxes. The tax rates are uniformly proposed to go up. So, and that's for high income individuals and companies and pass-through businesses. So the first proposal is that the top rate, which is 37%, will go back up to 39.6%, which is what it was before the 2017 Tax Act that President Trump got through. And that's for individuals over about roughly $500,000 of income. The top rate will go up. Another significant change is an increase in what's called the capital gains rate. Capital gains are typically taxed today at 20%. And the Biden plan would tax capital gains for taxpayers who earn over $1 million to the highest ordinary income tax rate, which again is that 39.6%. So savings or gains on long-term held investments like real estate and stocks and all would go up to that much higher rate than it is today. There's also a proposal to do away with what's called the step up in basis, which is when somebody passes away under current law, if they own an asset that has appreciated over their holding period, all of the appreciation in that asset goes away for income tax purposes because the asset is what's called stepped up to fair market value. So all of that gain never gets taxed. The Biden proposal would say upon death, in some cases upon gift of that asset, that would trigger gain recognition, which has never been the case as far as I can recall. That's significant. There's a code section that exists today that's heavily utilized in the real estate industry, which of course here in the Western United States is a primary driver of the economies in many jurisdictions. And that's what's called the 1031 exchange rule, which says if you sell your real estate and you reinvest in other real estate, you don't have to pay the gain on the sale of the real estate that you sold. And the Biden plan would do away with that like-kind exchange tax deferral mechanism for, I think, over $1 million of gain or $500,000 of gain. I don't remember the exact number. So that would be a fairly significant change. So that's kind of the big points in the Tax Act proposal. We'll see what happens with Congress, whether President can get it through both the House and the Senate.
So my question for you is, who do you think will be impacted the most by this?
Everybody. The tax changes are geared primarily to affect high earners. So that's why you see these rates kicking in at income rates that most people would consider to be very, very high incomes for most of the world. Many of our clients, of course, who own their own businesses and run their business and are entrepreneurs, fall into that category. They may not be there every year. There's a lot of businesses, as you know, when they start up, they lose money over time and before they become successful. But a lot of our clients who are in all kinds of businesses who don't think they make a lot of money will find themselves in these higher tax rates and paying a lot more taxes.
So for those individuals that are thinking about and starting to prepare their taxes, is there anything specific that you would encourage them to think a little bit more about or do some more research on?
Yeah, there's no substitute for advanced planning. And it's not just consulting with somebody like me, but also with their CPA, their tax accountant, who's kind of down there in the numbers and can kind of see where things are shaking out on a tax return or a financial statement, and getting it into his or her office as soon as they can to kind of start to sort through those things to see if there's any types of transactions or planning that they can start now that will minimize the taxes, assuming the plan gets enacted and in most cases would be effective next year. Now, there's one change that the proposal proposes to be retroactive to this year. In fact, it's proposed to be retroactive to April of this year, and that's the change in the capital gains rate. If that proposal goes through, transactions that took place or closed earlier this year, when you could argue you had no advance notice of what that tax rate was proposed to be, may be taxed at a higher rate if that goes through. There's not a lot of planning you can do for that. If it's retroactive, it's done. But going forward, get in and talk to your CPA and come in and talk to somebody like me.
With everything that you shared with our audience today, what is the one thing that you're hoping you take away from this conversation?
I think the best advice, and most clients do this, but the best advice for clients is to be proactive when they see a transaction coming down the pike, to get in and talk to not just their business lawyer, but their tax accountant and their tax lawyer. Oftentimes you can approach a transaction in a way that may be more efficient than you thought from a tax perspective for structuring purposes. The same goes for estate planning. People who are in their 40s don't usually think about what's going to happen with their assets when they're not around anymore. But that's the ideal time for entrepreneurs and business owners to start planning, because as you mature and your wealth grows, it becomes more challenging to plan the succession of your business and the transfer of those assets to the next generation without taking a significant tax hit.
So for those individuals that want to read a little bit more, are there any great resources out there, any websites, blogs, things that they can follow to stay informed about all of this?
if you really want to get down in the weeds, which few clients do, but some might, you can read what's called the Green Book, which is the proposal that was issued by the Department of Treasury, which goes in some detail about these proposals. There are any number of really good articles and blogs that you can get primarily from the big accounting firms. And a lot of those will have kind of rudimentary examples that you can actually look at and say, oh, okay, I understand kind of how that plays out, where it's kind of difficult to understand in the abstract what it might mean.
All right, Steve. Well, as we look to wrap up today's conversation, is there anything else you'd like to leave our audience with?
I don't think so. I'm hopeful that I'm glad to know that Congress is out there and the tax laws keep changing, so guys like me have something to do. But we'd welcome the opportunity to talk to clients and business owners about how they can plan their businesses and make it most tax efficient.
Great. Well, Steve, thanks so much for joining us on this episode of the Fen Talks podcast as we further discuss the Biden tax changes.
Thank you, Lindsay.